Welcome, everyone. I'm Angelo Robles, and welcome to Family Office TV. Such a pleasure to be here live today across my social platforms. Some of you may watch this a minute, an hour, a day, a year after the fact. Some of it is going to be evergreen. And we have one of our favorite returning guests today. So thank you all for joining us. Today's topic, and this is one very near and dear to my heart, but we're even going to expand it and do more. Building a family empire like Warren Buffett, of course. I have lots of opinions on this. I've done master classes about it. Part of my private club of my 30 founding members and anchor is dedicated to the value of investing in private companies and structuring holding companies and how to do it. And we have a returning guest with us today that probably knows as much about this topic and has deep intellectual thoughts of anyone that I know. So we're going to dive mainly into that, but we have so much else to cover. Uranium, nuclear, the stock market, AI, NVIDIA, and really some interesting updates that Ram will be talking about for the first time because it just happened on positive and or negative. We'll find out. So stay with us. This will be an engaging interview. Our guest is the return of Ram Ahluwalia. He's the co-founder of Illumina. And Ram, it's great to see you again.
Always great to spend time with you, Angelo. Thank you again for having me.
Thank you. So we kind of have this unofficial about every 6 months. We go about an hour and a half, 2 hours with Ram. This one may be just a pinch shorter. And we might even start to do these every quarter, as honestly, there's tremendous opportunity now. This is an election year. Look at interest rates, look at inflation, look at distressed opportunities, look at CRE. So there's so many things we want to talk about. Here's what I'm going to start with. I've traveled the world. I met with thousands of family offices. I met with the most iconic families relatively recently in Europe, and my trip to Silicon Valley and to Florida, meeting incredible families very recently in the last couple of weeks. Dynastic families, and I'm talking about some in Europe that go back multiple hundreds of years. What do they have in common? They own and often control private companies. It engages the rising generation. They're not passive investors passing it off. That's one of the reasons why often family wealth doesn't last beyond a certain number of generations. One of the reasons, and these are families, the Habsburgs and others in Europe that are telling me this, the opportunity to know how the world really works and invest in private companies. And there's never been a better chance than now where there's lots of inefficiencies in the market, and that creates opportunity. So the framework of our initial discussion, building a family empire like Warren Buffett, was, I've been on this for years, but this man, Ram, had an incredible, I still call it tweet, they're now X, and he's a must follow, Ram on X, that was stunningly detailed and really gave a lot of the secret sauce, although most people don't execute that well, in terms of what to do. So we're going to dive into that tweet as the initial part of our discussion, Ram, if you don't mind. And I think basically your premise was Warren is incredible. He outlined back in 65 kind of how you should do it, initially with a holding company. But we also have to admit, now with the passing of Charlie, who was incredible, and the fact that they're a monster, they're huge. I could argue the best days of Berkshire, nothing negative to do with Warren. They're just too big, are behind them. But you as a family, even a small billion or multi-billion dollar family, could absolutely create. Do not believe the private equity industry. They have somewhat lied to you. You can create a mini, and if you're a billionaire compared to Warren, it would be a mini Berkshire Hathaway. So Ram, I'd like to set the tone by a little bit sequentially going through some of the things that you mentioned in your tweet that I've been working on for years, but you had a different twist and gave me new insights, and I greatly appreciate you. So you spoke about it is absolutely possible. It'll take some capital. So this is for people with relatively deep pockets, unless a consortium of families get together. And you kind of outlined initially 5 different things. I think we need to dive into that because they're all going to require a little bit of context. So without further ado, you talk about initially what you call permanent capital. That can mean different things to different people. What did you mean by that?
Sure. So let's define capital that's not permanent. Blackstone's capital is not permanent because they've got to return capital to investors through the life of their fund, 8 to 10 years. A hedge fund's capital is not permanent because if they get redemptions on a monthly or quarterly basis, which generally is pro-cyclical, they're getting redeemed on at the best possible times to invest, that's not permanent capital. What is permanent capital? It's capital that cannot be called. So that allows you to take advantage of opportunities when the tide goes out and when asset prices are cheap, which is also usually when people have the most fear in the market. So that's one of the reasons why Berkshire Hathaway has an edge over all of private equity. In the 2008 crisis in October, that crisis unfolded so quickly, private equity did not get a chance to go raise a bank bailout fund. The Oracle of Omaha already had the capital lined up, and the planes flew to Omaha, and he got sweetheart deals, off-market deals, because he was ready to provide liquidity and inject capital into those kinds of opportunities. So that's what permanent capital helps you do.
I think that's huge. And you just really mentioned arguably the number one benefit that you as a family office have, even if a modest size one, like me, investing in car washes and rolling up and things like that, you do have the opportunity of permanent capital. We have time on our side. Private equity firms need to deploy capital. They need to have an exit. They often, quote unquote, overpay. They also are subject to regulatory issues that family offices may have usually more freedom on. Now, I'm not going to make this a discussion about the Corporate Transparency Act and beneficial owners. My concern is that could segue into the government looking to do more and more disclosures for single family offices, which would take away from the freedoms and liberties and shine. There is no question family offices have a massive advantage there. Number two, you talk about tax efficient. What did you mean by that?
Sure. So Buffett has 3 drivers of tax efficiency. One is he does borrow and has an interest tax shield from his borrowing. Now, his borrow cost is very low because he's a AAA rated player, but he takes advantage of what's called an interest rate tax shield. Borrows over $100 billion, by the way. Okay. So that's one. Second, he's got depreciation on the assets that he acquires. That creates another kind of tax shield to insulate from the income generated by his businesses that are cash flowing. So the third is when he acquires a business, he likes businesses that have brands. And when you acquire a business that has a brand, generally you see that reflected in the goodwill of a company, right? So the goodwill is defined as your acquisition price less the marketable value of the securities and the assets. And that difference is goodwill. It's the price of these intangibles. There's some value that the acquirer assigned here, and that goodwill can be depreciated as well. So there's a reason why Buffett likes brands. Brands have multiple benefits and advantages, whether it's Wrigley's or Coca-Cola or Dairy Queen or NetJets. But one of the other advantages is that you can depreciate the acquisition cost of the brand, even though it's actually helping your business. So tax is a big part of this. One other part I want to call out, though, is back to private equity and the difference between Buffett and private equity is private equity firms have to sell their best assets ultimately. Warren Buffett doesn't have to do that. He can hold on to his finest prized crown jewels forever and let them internally compound. Private equity has a clock to them. And private equity has built some incredible businesses. Like Invitation Homes was created by Blackstone. They were birthed in the wake of the 2008 crisis, and they created the asset class of single-family residential homes. And now there's a big capital market around it. There's asset-backed securities financing this asset class. it was a great business. I wouldn't buy it today, but all to say is Blackstone is forced to sell that. Now we have a housing shortage. Those are assets I think they probably would have want to kept. And actually, Buffett at the time, when Invitations Homes was being built, he said, "Look, if there's one asset I'd want to buy in the aftermath of the 2008 crisis, it'd be single-family homes." That's another advantage that Buffett has over private equity.
It's many. You mentioned number three, which to some, I think the first two are relatively straightforward. Number three could be a little bit more complex. So if you could break it down, and that would be, you write, non-callable carry trade. What did you mean?
Yeah, this is a really interesting technical point, but it is a crucial one. Okay, so some investors identify securities that they expect will appreciate in price based on high sales or earnings growth. Those are often like tech stocks, for example, right? Buffett is doing something else. And maybe what I can do is share my screen here to make this more visually clear. And those of you that are finance junkies and know the tangency portfolio will understand the point that I'm about to make. But I'm going to try to explain it as simply as I can. What Buffett is doing is he's not looking to maximize the total return from any given investment. He's looking to maximize the risk-adjusted return.
Exactly.
Okay? So he's looking for assets that throw off cash flow, and those assets have a spread over the funding costs that Buffett has. Like the metric you might use here is called like return on invested capital. Okay. So he's looking to compound assets and capture that spread between the return on the asset less the funding cost of that asset. And then with that cash flow, plow back into the business and internally compound. But let's break this down a bit more, because I know that's, a lot of that is kind of like finance jargon. So I'm going to share my screen here. Let's see, share screen. I just looked up kind of efficient frontier, can nerd out here a bit. So
I'm going to add it to the stage, Ram. So give me a second. I think we're there right now. There you go.
Got it. So like what this shows on the y-axis is the return of an asset, and the right-hand side shows the risk or the volatility of an asset. So what most investors are doing is those that seek to maximize total return, they're finding an asset that is high return, but also has high risk. It's somewhere on the higher end of this blue line right here. Okay. And give me a moment here. Tangency portfolio. Let me look this up here. There we go. It's much better chart. Okay. So if you look here, what Buffett is, investor A is trying to find this asset. You see that dot on the efficient frontier. It's got high return, but also has high volatility. Okay. Maybe that's like Snowflake, which is down 40%, down a lot, right? Buffett, these are risky businesses, right? Because high earnings growth, high sales growth attracts competition, right? And those names are often glamour stocks. They get bid up a lot. They get expensive, and they have risk of disappointment. Look at cybersecurity stocks, for example, okay, where the forward PEs are very expensive. Now, here's what Buffett is doing. Buffett's saying, I want high return, but I don't want that risk. So he's finding this portfolio, this little dot in red. It has lower volatility. Okay. These are cash cows. And he's borrowing with debt.
Exactly.
To extend the return from this asset on this line here, this diagonal line that we draw from the risk-free rate, which he borrows pretty close to at the risk-free rate as a AAA borrower. And obviously the insurance float helps as a source of financing. And he is accessing a set of opportunities that dominate the opportunities others have to access in the public markets, right? If you buy an asset, you're not financing that with AAA debt. You might finance it with margin debt, which you shouldn't do, but that's callable debt. So in addition what Buffett is doing is he's financing with non-callable debt. That means he cannot get a margin call. So he has permanent capital and permanent financing. He's linking the duration of the asset, which he wants to hold forever, with the duration of his financing. Okay. So very difficult for investors to do this in public markets. You can't do it in public markets. You can do it in private markets if you approach your financing carefully.
Excellent. And yes, I know that was a little bit of a complex subject that the charting did help. And again, honestly, Ram and I could do 2 or 3 hours, effectively maybe a masterclass, 4 to 6 hours on this. So this is somewhat of a condensed version. And somewhat the devil is in the details. I have deep experiences and a deep network of families, and Ram has incredible intellectual horsepower. There are going to be some families that are going to want to move forward more strategically on this idea. Many of you will listen and not take action because that's the majority of people, even those that are very successful. There will be some where this, if you want to call it a brief and condensed masterclass, is going to be incredibly valuable. And it's okay to have mentoring and help. That's how you expedite and get things done. What I'll add when you mention non-callable carry trade, given my experiences in GP and LP structures, some may take that. And again, I don't mean to keep on kicking PE funds. For some investors, they are the best option. But realize that in certain PE carry structures, the GPs could also monetize part of the carry in advance. Another advantage they have that's deeply worded in the contract that you probably never figure out. And, maybe they're 2 or 3 months in the Hamptons in the summer, they're monetizing their carry. This is the reality of what happens in a lot of hedge funds. And I know it's a different industry, hedge funds and private equity, but GP and LP structures, once they become successful, too institutional, too large, don't really care about the private investor and want to placate to large institutions that are happy with 6 to 7%. And I'm being a little tough, returns. Subjects we'll get into perhaps later. Your number 4 is high return on equity, ROE. What did you specifically mean by that, and why is that important?
So let's go back to the establishment of Berkshire Hathaway. So Berkshire Hathaway was a textile mill that was in decline, and Buffett acquired this business, and it was a cash cow. And that cash cow was used to finance the acquisition of other businesses. And the Berkshire Hathaway name stuck. They just took the name of the textile and put it on the flag, the masthead, and the rest is history. So the key is, you want assets that throw off cash flow so that when Mr. Market, either public or private, has a dislocation, you have a move to make. You have liquidity. You have liquidity through the cash generating power of your assets. So one of the metrics that Buffett likes is return on equity. His return on equity is the net income generated by an asset divided by the equity cost of the asset. He likes 20%. Okay. If you look at the free cash flow generation of Berkshire Hathaway in a given quarter, even, it is substantial. He's generating so much cash flow every quarter. When there's a market dislocation, again, he's got the liquidity to make a move. And by the way, his cash flow generation is even higher for wholly owned businesses. So Buffett Berkshire owns 80 plus businesses. And so the free cash flow that's generated by those firms, he can access and tap, as opposed to having to rely on a dividend yield in public markets. And that's a big difference. Okay, let me illustrate with a simple example. JP Morgan has a return on equity of 15% plus, which is extraordinary for the United States' largest bank in the land. Okay, 15% return. Talk about scalable compounding. Okay. However, the dividend JP Morgan pays is relatively paltry. It's a couple points dividend yield. Okay. If you're Berkshire Hathaway and you own that asset outright, the cash flow stream you access to is the full 15%. You can do a lot with that. You can do a lot with that. So those are, the reasons why, like See's Candy, for example, he bought decades ago, has returned over 80 times its initial capital. So, the idea that you can, harvest the cash flows and then internally compound. Internally compound is like a word that investors have forgotten in the go-go 2010s, which were tech oriented. Everything went up and to the right. Things went up and to the right because of earnings growth and because of, multiple expansion. But that idea of internal compounding, it's like, hey, how do I take cash flow and plow it back into my business and grow that business, right? So if I have return on invested capital that's positive, let's call it 20%, and I have incremental projects that will generate that return of 20%, I have cash flow and I can invest in my own business and grow. That's a wonderful thing. That's what JP Morgan has done, by the way, of course. So that's the opportunity that a family office has in the private markets. Because if you're buying JP Morgan today, you're buying that asset at a price to tangible book value that is expensive. It's a great business, right? Whereas if you access opportunities in the private markets that are less covered, less picked over, for example, lower middle market firms where private equity doesn't play, or those firms cannot access financing, the multiples are cheaper, where there's an opportunity to consolidate, perhaps, there are different ways to approach it, then you can build a machine that also internally compounds with the cash flow generation of the business.
I mean, maybe one comment I'll make building upon that and kind of what we're leading to. I do believe the private equity industry is a little bit afraid of the threat of larger scale family offices. Look at Byron Trott's organization, BDT, their merger with Dell. This is getting so overlooked in the single family office community. It's scary to me. I probably have to do a whole program about it. The industry of traditional GP and LP is absolutely knowing the freedoms, the lack of time constraints that family offices have, and somewhat a little bit more, let's call it more favorable regulatory. And then they try to sell the fact of, oh, you need to have a team of dozens and dozens of people. Well, I learned a lot of this from, at one time, one of the 5 richest people in the US, the head of this family office, whose name is Ed. And by the way, that person as a principal was Ron Perlman. Very similar to what you're describing. Yeah. He purchased a licorice company. You heard me right. I think it was 78 or 79. And built an incredible holding company and empire. And now you're asking, oh, Angelo, I hear all these thought leaders. What did he have? 40, 50, 70, 100 people in his family office? You've been lied to. He had about 5. There's someone now who's worth $3 billion, whose name you would recognize in LA, that is controlling a lot of interest in water and food. How big is their family office? Like 7. It's about the holding company, the operators in a holding company that may answer to aspects of the family office, but to believe, unless you want to convert and become a GP structure yourself, you do not need a large staff. It's a lie. You've been lied to. And I'm exposing that in some of the issues relative to private equity funds, which, by the way, their fees are not transparent. You don't know exactly what you're paying. It's more than the 2 and 20. Read it. It's ridiculous. And I know I'm getting a little bit harsh.
A lot of fees are passed to investors.
Exactly.
It's not just true for private equity, but it's true for hedge funds as well. And
I'm going to tell you the flat out truth.
Look at Millennium. I mean, the Millennium fees that are passed on to investors are significant.
Sadly, this is a sad state of affairs. Why do most family offices settle for this? The family is kind of removed. The family office executives are non-bloodline. They're good people who are smart. They've gotten a little comfortable. They're taking the easy way out. If I invest in Blackstone in this and something goes wrong, it's like buying Big Blue. Yes, it is harder to structure the holding company to be a true direct investor. But if you want to have dynastic wealth beyond 3 generations, engage the family, there is no other way. Do not be lazy. I said it. And again, I know I say things that get my brethren in the community a little bit and upset and in trouble, but this is a reality of it. This is what I see. You do bring up as number 5, and then we'll flow into banks and other things that are going to be important to tie this together. You define, which you already hinted at, but we'll dive a little deeper, high cash flow with depreciation. What did you mean by that?
Right. So, you want assets that throw off cash flow. Cash flow is king. You can buy other assets with that in a periods of dislocation. And you've got a lot of things you can do that. You can buy back your own stock if you can't find other assets. You can buy assets in the public markets. You can deploy capital to one of your 80 portcos. But cash flow generation is crucial because you're not relying on multiple expansion. Multiple expansion is a function of animal spirits, fear and greed cycles, liquidity cycles. If you own a great business and then you can compound that, you can get a return on your invested capital, then you're going to do fine. Charlie Munger, after Berkshire Hathaway, he had a substantial real estate multifamily portfolio, for instance, right? Very substantial. Same thing. Well, what does multifamily let you do? It lets you invest cash in an asset that has a return on invested capital. And if you finance it correctly, you get long-term financing, not short-term debt, exposing you to floating rate risk. And you can offset the taxes that you might otherwise pay on that cash flow with depreciation from the asset you bought. Then you're in a great spot. Because, if you're an investor in that asset, you're going to kick a K1 to yourself from your family office entity, and you're going to have a passive income corresponding to that cash flow and a passive loss corresponding to the depreciation. That passive loss is not a cash flow item. It's an accounting entry. And in a world where taxes are going up, right? We've got wartime level deficits. Being thoughtful about tax and how you compound and avoid, capital gains through an investing strategy like this makes a ton of sense. And Buffett also benefits from that too. You don't see short-term capital gains. You don't see long-term capital gains. Only when they sell an asset, which happens very infrequently, right? I mean, he bought Coca-Cola, I think, in 1986, and gradually starting to sell down that position, and so forth. So that's the connection between cash flow and depreciation.
And an important part to bring up, and I know it's harder now than it was back in the 70s when Buffett through the late 60s was really getting really started in Berkshire Hathaway, but I think it's very important. We could do another 2 or 3 hours on this. We'll probably keep it a 3 to 5 minute segment. The super rich do have something in common that I notice among people that are often decabillionaires and a little bit more out of the US, meaning international. My experience is going to Africa, United Arab Emirates, Europe. They own banks. You could argue it may be control, but not 100% ownership, but that has gotten more complex.
Yes.
In the US lately. Again, we could do hours on this. What would be your recap of the value of owning banks?
Well, I'll bring it back to Buffett again. So Buffett loves banks. People think about Buffett, they connect him to insurance. Before he got into insurance, he got into banks. So what are some of the banks Buffett has owned? Bank of America, Goldman Sachs, Ally, American Express, all right? Wells Fargo. Buffett loves banks. Why? A bank lets you borrow short and lend long and capture spread and compound with non-callable financing unless you get a bank run, right? FDIC insurance helps protect against that. And obviously, you can term out your debt with certificates of deposits and all the rest. You can issue bonds. And so banks And there are a few other industries like this, but banks have this set of properties that matches all the things we talked about before. You can, first off, you got a moat. It's hard to acquire a bank. The barriers to entry are significant. They shouldn't be that significant, but they are. That's why JP Morgan's not facing competition from Amazon's theoretical bank branches or Google, why they're not competing with Visa and MasterCard.
That is huge.
Or why Tesla is now in the auto financing business, which would help them grow their income with cheaper financing, right? These big tech companies have a ton of capital. They can borrow cheaply. They can build technology. They can build great user experiences digitally or embed them in retail branches like Whole Foods. So, the JP Morgans of the world are insulated from competition, which is a great attribute. You want a moat and you can compound, right? So if you own a bank, the old joke about banking is it's like the 5-3-5 club. You lend at 5, you borrow at 3, and you go home at 5. So, or you go play golf at 5. If you're a community banker, it's like the 5-3-2 club. You're going home at 2, right? I mean, in general, if you look at the quality of management in banking, it's pretty low in community banking. The quality of management at the largest banks in the United States are actually very high on average. They're actually quite high. But in community banks, these are very simple businesses. They generally make commercial real estate loans, which is probably not the category I would focus on. I don't think it's the best category, actually. But what does that tell you? What is another thing Buffett says is you want to invest in a business that any idiot can run, right? And the community bank sector doesn't have the best quality management. Now, running a bank is complicated. It's highly regulated. The regulations increase each passing year. Now, there are lighter regulations for smaller banks, which is an advantage versus larger banks that have to comply with pretty onerous requirements. In fact, the businesses like Cross River Bank acquired my prior startup, Pure IQ. That bank started as a community bank in Teaneck, New Jersey. It was acquired by the founder and investing group for $10 million. I want to say like in 2008, 2009.
Mm-hmm.
Then Andreessen Horowitz gave it a valuation of $3 billion in 2021. Wow. 11 years from a $10 million purchase price to $3 billion. Now, maybe markets have corrected. Maybe that $3 billion is worth $2 billion. Does it really make a difference? No. Here's another one. Live Oak Bank, started by Chip Mahan, and who's an incredible entrepreneur. I've had a chance to spend time with their leadership team. That charter was also started in the 2008 timeframe. I don't know what the market cap is now, but it's gone up substantially. And they spun out a company called Encino, which is worth multiple billions of dollars. Right? So, if you have good management and you find a good niche to build around and focus, here's another one for you. First Republic Bank, obviously, is not with us anymore. It's been gobbled up by JP Morgan. So First Republic, I was actually at Merrill. I played a small role after the acquisition to help integrate this into Merrill. But Merrill bought First Republic, I want to say like 1.3 billion or so. And I got a chance to look at the P&L. And I was like, wow, this is an incredible business. So what First Republic did is they were originating jumbo mortgages. These are mortgages that Fannie Mae or Freddie Mac don't finance. So there's a gap in the market there. And First Republic was then sold by Merrill to General Atlantic, world-class private equity firm, right? In 2008 crisis, Merrill needed capital and liquidity, okay? First Republic went public by GA for about like $1 billion and change. And in 2021, from trough to peak, First Republic went up 40x, about $40 billion in market cap. 40x return. That's outstanding. That's better than many of the big tech returns. Now, it went to zero not because of the business model. It went to zero because of gross negligence on the CFO and the CEO's part. Namely, they did not sell off their fixed rate mortgage portfolio. So when interest rates widened, the value of the assets that they were financing declined. and that wiped out their equity. And they were acquired by JP Morgan, who happens to be the number one leader in securitized products for mortgages. In fact, we actually made that prediction and that JP Morgan would buy First Republic, and that's exactly what happened. That's why. So the business model is very good. They did not risk manage. They didn't finance the mortgages correctly. They could have just sold it to JP Morgan. They would have been fine. And or do those are quick examples of banks that have done extraordinarily well and are internal compounders. And guess what? Banks are cheap. We had a regional bank crisis spring of last year. Banks are still cheap. I own a bank with a 7.6 PE ratio that's internally compounding. And the opportunities for banks to get after gaps in the market is significant. The jumbo mortgage gap is one. The Puerto Rico market is another.
Absolutely.
There are a lot of ultra high net worth investors or individuals that are entrepreneurs, exited founders, GPs of private equity funds, and all the rest. And you cannot get a jumbo mortgage in Puerto Rico. Banco Popular is a leading bank in Puerto Rico, by the way. Can't get a jumbo mortgage. There are private credit funds that lend, they'll give you financing, and the rates are absurd. The only game in town. That's an example, but you could go on and on and on. Middle market financing. These are the categories where if I owned a bank, I wouldn't focus on the commercial real estate, providing back leverage to private credit funds. So the private credit, as you know, is a big new trend. Been actually a trend since the 2008 crisis, $1.5 trillion asset class, right? The regulator said, hey, look, bank, if you touch credit risk, I'm going to make sure you hold capital against that. So your economics are worse off, right? Your return on equity is going to be lower than it was pre-crisis. And so what happened? Blackstone, Apollo, KKR, and many others have stepped in to do lending that banks were previously doing before. So the new trend you're going to see, Live Oak Bank is doing this now, for example, I mentioned them earlier, is banks are going to lend to the lender. They're providing back leverage to the private equity firm. The private equity firm is originating, acquiring, underwriting the borrower, going to the bank with a loan package and saying, here's a portfolio of 100 assets, cross-collateralized. Can I get financing on them? That is what's happening. That's the transformation of bank versus private credit lending that's playing out right now. I would try to index against that theme. But how do you do it? Which funds do you underwrite? How do you source this opportunity? Go to the good private credit. There's a lot to work out, but those are examples of an opportunity where you can build a Buffett business. And banks are under consolidation as well, right? I think 15 years ago, there's 10,000 banks. Now there's 4,000 and change. And the number one predictor of when a bank gets acquired is the age of the CEO.
Yep.
So the age of the CEO, and related to that, do they have an heir? Because these are multi-generational business. Look at FCNCA. FCNCA is a ticker. I think it's First Citizens National Bank. So they acquired SVB, Silicon Valley Bank, which of course blew up last year. They bought it from the FDIC. That bank has outperformed the S&P 500 for decades. For decades. Okay. I'm not saying go buy that stock today, by the way. I looked at it the other day. Now's not the right time, But, that stock has done very well. It's a bank. It's run by a family. They've done very well. They know their niche. Their niche is picking up troubled, discounted assets from other banks. And they know what they're doing. They've got a playbook. Live Oak Bank has a niche financing veterinarians and funeral homes, for example. They have salespeople that go out to the veterinarian universities and they establish a relationship at graduation. How do we finance you? Equipment finance for doctors, right?
Yep.
There are all of these niches.
Great businesses.
Great businesses where their niche, they're too small for JP Morgan, Bank of America, and Citigroup to get after. Those guys are financing large multinational corporates. And the regional banks are on their heels. They're trying to conserve liquidity. And their cost of financing is going up to keep the deposit. and they're dealing with commercial real estate issues, which is not the best category to be lending to, right? So those are, I think the banking sector is a tremendous opportunity to build a world-class franchise, internally compound, take advantage of the dislocations that are out there, and the fact that these assets are cheap right now. You can buy assets below replacement cost. I mean, I haven't checked Barclays recently, but the price to book ratio is 0.6, meaning like if you sold, it was like 4 or 5 months, I don't know where it's today, but if you sold Barclays, every line item in that balance sheet, you would get more cash than the price to acquire those assets. Citibank, same thing. Okay. So banks are cheap right now. And the other point is that the markets, public markets, aren't valuing these businesses correctly. Or you could say that in private hands, you can compound them better and, you'll do well. So some assets just are not rewarded well in public markets. They're cyclicals. They go up and down on the cycle.
Of course. That was a fantastic overview. You gave away some of our secrets on banks, which is great. I want to give back to the audience a little bit of context. After my exits, I created in Wyoming a holding company. It's not a lot of money. Again, like I said, I'm an investor directly in companies, some with a controlling interest, admittingly, maybe not at a quote unquote single family office level, but it's a start. You have to take the action. Imagine the real damage that real family offices could do. To give a little bit of context, look at the baby boomers in this country. A lot of them own businesses. Do you think their children, especially in a lot of blue collar, quasi-recession resistant businesses, want to take them over? I can tell you they don't. I believe the math, 2.4 million businesses technically in the US for sale. Do you know that over 90% of them will not sell within 1 year? Now, are most of them, even for smaller family offices, a good opportunity? Probably not. But if 5% of them are, that's incredible. And maybe certain industries, or depending on the EBITDA and multiple, are below the radar of private equity, the opportunity for roll-up. And the seller financing provided, there's tremendous opportunity. I go back to what I said earlier. Some of you are just too lazy. You don't want to put in the work.
I would say this is a leadership gap. We'll come back to that in a second. By the way, your point on roll-ups, excellent. Here's an example. Elective health is a major trend. Health and wellness is a major trend. Fastest growing demographic cohort, the oldest of the oldest, the boomers. They're living longer. They got disposable income. And like acupuncture services, for example, or physical therapy. There's no national brand for that. You have a national brand for Planet Fitness, the Equinox, the World, New York Sports, whatever it might be. But there's no national franchise, and there's roll-up opportunities. I see it in my backyard. I can see these mini franchises start to develop, or other elective health offerings, whether it's at-home infusions, at-home care, right? You're gonna need a lot more of that in the future.
Mm-hmm.
So I think the roll-up play is a good one. There's daycare plays. So a lot of ways to approach this. I think the key gap is it's leadership. It's leadership. The family office has to find a leader from the industry that has the right vision and has the execution skills. So vision is cheap if you can't execute. So that's the thing. And then you have accountability on the leader. The leader will then assemble the team, build and execute on the plan.
Which really gets to one of my Angeloisms, as some call it. The best SFOs, the best single family offices, they do one thing brilliantly. That's all you really need to do. They hire well. The greatest value, you can look at people, systems, and technology. They're all important. It's more than just those big three. People are by far the biggest driver.
And that's where family offices don't know what to do. Like recruiting is hard. If you can recruit well, you got
it. I mean, that's the one secret. And that applies even the issues that we're talking about today. Just how do you run a successful family office? You got to get that right.
Exactly.
We're going to begin to segue in about maybe 5 or 10 more minutes away from the core topic. And we're going to segue into so many other different topics Ram has been very generous with extending his time. For those of you that are a little bit new to me, by the way, I'm Angelo Robles. Many people know me in the family office world as being the longtime founder and near multi-decade CEO at Family Office Association. I had an exit. I'm out. Went to Wyoming, traveled the world, set up my holding company, private trust company later this year, and I'm a little bored. So I love to do interviews. I love to learn. I have a pretty prominent platform on YouTube at Family Office and a newer one, Family Office TV. That's on YouTube as well. And later today, live across my platforms, including LinkedIn, I have someone that I believe Ram knows and has heard me interview before. I have an incredible day today. I learned so much from Ram. I'm going to go back and watch this interview and take notes myself. And I have, Ram, are you familiar with Adam Robinson?
Oh, Adam Robinson's incredible. Well, I think first created his wealth by building like SAT prep courses. And then he got into chess. And he advises investors and like hedge fund managers, and he's got decision-making frameworks.
You have Ram, who is modest, telling you that Adam Robinson is incredibly intelligent and a special intellect and talent.
Yeah, Adam Robinson's really impressive. He's really impressive. You got to. I tune into when he opens his mouth. Like, all right, what's Adam Robinson talking about?
Man, you're really selling my live and my podcast today. So 4:00 Eastern, live on my socials. So follow me if you don't. LinkedIn's probably the most convenient, but go to YouTube. I believe it's my 5th interview now over a couple of years, a little similar to you, Ram, digitally with Adam. He's been on Tim Ferriss 4 times. He is absolutely an incredible intellect. I've interviewed him in person at my programs when I was running Family Office Association as well. This man, trained under Bobby Fischer in chess in the 70s, is beyond brilliant, special advisor to multi-billion-dollar hedge funds and family offices. We will be talking about everything: the stock market, the Caitlin Clark effect, Russia, Ukraine. I'm very active in geopolitics and macro, and I do love long form intellectual discussions. I'm a little different than what you may be used to in the family office world, but I hope you enjoy it. So that's 4:00 Eastern today. For those of you that are live, swing on over. You can interact. Go to my LinkedIn. You'll figure it out. I had Leon Cooperman earlier this week, and if you go to my YouTube, you could watch the replay of that. Hedge fund legend, probably worth about $3-4 billion now, with incredible insight and still very active as a family office and a private investor. I do these frequently. We're going to wrap up a little bit of this segment probably in 5 or 10 minutes, Ram. But in that now legendary tweet that people are going to definitely have to go to your platform and look up, you did state requires $1 billion across a consortium to acquire the operating assets, the modern day quote unquote Berkshire textile mill.
Billion here is not that big deal anymore.
That you had 2 or 3 candidates, which I probably recommend we keep that a little close to the vest.
Oh, well, sure.
And you did mention roll-ups and attractive small cap businesses in various sectors.
Right.
And I think the third step you mentioned is financing the growth in private credit with cheap deposits, banks and others. Maybe put a little bit of a bow on this subject. How would you wrap it up?
So there are a couple assets in public markets that have very attractive return on equity. Number one, which you need. Number two, they're not priced correctly in public markets. They're not rewarded in public markets. And 3, the market caps are small enough where it can be digestible. In fact, some of these businesses have been owned by like Apollo before. Like one business I'm thinking about right now is owned by Apollo, then it was sold. So there are a handful of these businesses because you got to start with the first textile mill. For Buffett, it was Berkshire Hathaway. And you need a core business that throws off the cash flow to finance the acquisition of other businesses and can compound. Doesn't even need to, that first one doesn't even necessarily need to compound. It can throw off cash flow with a long tail, and you can use that to then acquire other businesses that are the compounders too. So yeah, I think there are opportunities out there in public markets that are attractively priced to build this and get after it.
not quite finished with the topic yet, because I think I'd be remiss if I left out another play related to this is acquiring brands. When you buy a brand, you could, you get the value of the goodwill. Goodwill is the difference between your acquisition price less the accounting or book value of the firm. In other words, the brand could be very intriguing. And depending on what kind of company and customer, let's call it being sticky, how would you define goodwill and the value in what we're describing today?
Well, I think you got the definition of goodwill correct. I'm not sure I have more to say on that other than that, yeah, like there's a benefit to acquiring an asset called the brand that you get to depreciate to get a tax benefit from.
And in terms of, now we'll put a little bit of a bow on the subject. And by the way, speaking a little bit on Ram's behalf and mine, we're both passionate about the subject. We both go after it on the value of families need to be more active, in my opinion, as direct investors. We have a little different twist to it. I do private consulting and the work that I do with families. Ram also is an incredible intellect. I hope we're going to combine and maybe share some potential clientele and opportunities. What I will tell you, and I'm not going to mention his name because he may be listening now, one of my relationships is a very, very prominent person, a little bit older, sharp as a tack. Oh, he has a little bit of experience with this. He's invested in over 900 private companies. And he's another one that will tell you, you do not need a overly large family office staff. You need the right people, the right holding and operating companies. You do have to, there's a little bit of art there. So you kind of have to know what you're doing. I'll talk a little bit about ways you can engage from that perspective in the future. Yes. Again, me and Ram are keeping this relatively modest in length. We're going to begin to transition. There are some things we left off the table and simply have an opportunity to reach out to us and have an opportunity in terms of learning more. If you had to put a bow on the subject, Ram, and maybe recap it and have a little bit of a close to it before we segue, I'll leave that floor to you, please.
Let's take a step back on where we are. We have elevated inflation that's sticky. That's one. Two, we've got an incredible amount of disruption in the years ahead due to the rise of AI that can transform a business from a winner to a loser almost overnight. Look at Adobe, for instance. Three, you want assets that are going to be resilient to that change, that can compound, and are inexpensive. And I think there are compelling opportunities out there. And we've talked about several of them. Valuations in markets are now expensive. They were really cheap in October, right? Now they're expensive. So, you make your money on the buy. Your entry valuation is a number one predictor of your 10-year future performance. So,
and by the way, the person that I mentioned with 900 investments in direct companies the last couple of decades, to him, sourcing the right opportunity, getting an edge, having a little bit of a team, you can now utilize certain AI services that can help to uncover good companies to go after. And don't believe just because me and Rob are talking about this, that everyone on the Zoom now, or when I share this with hundreds of family offices on my platform, they'll listen to it. 1 or 3% are really going to be a desire to move forward and take action. And I learned some of this from Tony Robbins. You could kind of give people the book of how to do it. The reality is they often, and nothing wrong with this, need some hand-holding, because the experiences that we have doing this over decades, we could accelerate very quickly in a couple of weeks, a couple of months.
Leadership and initiative. By the way, like to your point, look, there are a lot of small caps out there that have debt issues. They're fine businesses, except they're upside down on their debt, for instance. And they're in a peer group that could get rolled up. You're seeing that in the RIA market, for instance, right? Private equity is all over that already. I would say that's an example, a case study of what you can do here. But the other categories, if you want to buy a bank, I'm happy to have a conversation. I know Angela would too. I think that's a great category. And you need, leadership that comes from banking where they know the regulators know them. I'm excited about that opportunity. I know we at Lumina are excited about that thesis in general.
And I could tell you what's worth its weight in gold. Most of them, honestly, are a commodity. I'm just being honest,
They
telling you the
are.
truth.
It's a simple
And that
business.
is, you need incredible tax person, someone who's top 1%, someone that the Forbes 100 people deals with. You got to pay them a lot of money. But Ram, what would you agree or disagree that knowing how to the nuances of net operating losses, knowing how to
Oh
structure
yeah. Well, you're right.
a holding company, it's huge.
There's so many layers to this stuff. There's so many layers. Like what you pointed out, you can acquire a business that has accrued net operating losses and use that to offset somewhat the purchase price of the business. So I think people have been reading that outside the Mag 7, there are hundreds of companies that are actually seeing earnings declines, right? There are companies out there that have lots of operating losses. The same way that you can get a carry loss forward if you've got a tax loss, opportunity, harvest opportunity. There's a lot that one can do to approach this.
I'm going to name a couple of sectors, so I guess we're not quite finished with the topic yet, that relates to the topic of what we're describing. Any specific opinion on energy, both traditional and more modern, on the defense industry, which I'm also intrigued by defensive plays, and a little bit random out of the blue. I have my reasons, liquor and spirits.
So I've less to say on the defense side. On the energy side, we've done a lot of work in that category. I'll give you the headline messages. Number one, the world needs more energy. The transition to renewables is going slower than everyone thought. Countries are behind their target schedules. Renewables are challenging because the sun's not always shining, the wind's not always blowing. And Ukraine-Russia war has disrupted the supply of uranium. So old energy is still needed. People aren't transitioning to EVs as fast as people thought they would. Tesla's revenue declined this quarter. Ford's kind of EV plays have declined. It's just a consumer preference thing and other factors too. Auto insurance costs are higher for EVs and resale prices are dropping. So you save money on your gas, but then you pay it in insurance costs and you walk off the lot with 30,000 depreciation, whatever it might be, 20,000. So the energy is, the world needs more energy. In Mark Zuckerberg's earnings call last night, he was talking about the need to acquire energy. If you have a data center can consume 50 megawatts of energy. A very powerful data center, the data center that will birth AGI, artificial general intelligence, probably is a gigawatt of energy. A gigawatt is equivalent to the energy produced by a large nuclear power plant. Think about that. You need to have a nuclear power plant powering a major data center. The world needs more energy. The number one driver of earnings growth for utilities are data centers. And utilities, they have like 10-year planning cycles because there's a lot of permitting that's involved. The municipality has to be involved. Regulators, you got to think through transmission lines. People don't want that running through their backyard. And what's the source of power, right? Like coal stocks have been going up. People don't want to consume coal, but the world needs energy, right? I think there are a lot of opportunities in energy and energy transition and electrification of the grid. So that's a category we're spending a lot of time on. We think one of the best expressions there is thinking through what we call the nuclear renaissance. We think there's a great thesis around that, and we're investing against that.
And Ram, I think the last two times you were on in October and the summer, I always seem to ask this question. I don't know, the audience seems to like it. Among the Magnificent Seven, and look at the amazing things that NVIDIA has done moving up those ranks. Perhaps one day, who would have imagined it, the world's largest company? We'll see. But the question is, who is maybe primed, or a sector, maybe it's biotech, I don't know, longevity issues, to move into that? Who is potentially going to go out of it? And why has Microsoft, kudos to them, The only company that has really been at that level decade after decade after decade, and one more time for a fourth decade.
This is going to be a super fun topic. So, by the way, real quick, I just shared on my screen URA ETF.
Audience, be patient. There we go.
Angelo, when you and I had our first chat, it was around July 6th or something last year. Uranium was around, here, this level. I want to say 20. Now it's around 30, 50% gain in less than a year. By the way, the price of uranium's gone up like 400% over the several years, and the supply has not responded. I can't think of a time when the commodity price went up and supply didn't respond. When lumber prices went up, supply responded. People started producing more lumber. Uranium has constraints that make it difficult to do that. We should double back on uranium. I think there's a lot there. Small modular reactors and all this, because it's linked to the data center trend. And but yeah, so that was great. We're very excited about how we do with uranium. And so on Mag 7, this is, we talked about Tesla in October, if you recall. You said, Ram, will Tesla be a part of Mag 7?
You remember that
10 years from now. And I think there was literally no processing from brain to like the muscle, and it was like, no, Tesla will not be part. And now we're seeing that play out, right? I mean, Tesla stock's down 40% year to date. So not Tesla. Apple has no earnings growth. They're going to report next week. Their earnings growth was up 0.5% last quarter. They're so big. The marginal customers in China, they're feeling competition from domestic Chinese competitors who prefer other products over Apple. By the way, if you have a friend with a Samsung Android phone, play around with that. Check out the features. Ask what they do.
Cool.
Great. Yeah. Better than the Apple product, actually. Apple, I mean, what's the difference between this and Apple version 7? I use Apple products, by the way. I'm just trying to call a spade a spade. I'm hooked in the ecosystem. I don't know. It's easier to move these out of the ecosystem to Androids, by the way, than it has been before, too. So not Apple. Okay, so now you've got, Microsoft, NVIDIA, Meta, Google. Netflix is going to have issues in a few years, I think, where they're going to run into limits to growth around that. So that there's a war playing out across Mag 7. Very notably, Mark Zuckerberg on the earnings call last night, he changed their approach to AI. And he said this, he's like, before we thought of AI as an opportunity to kind of infuse their experience, their hardware, their software, the apps, and infuse it with AI, transform it, level it up, and get the Ray-Ban, get a new form factor. Their goal is different now. Their goal, still consistent with that, but what they said is, like, they rolled out Meta Llama 3, which is the leading open source AI platform. It rivals GPT-4. And they went from 0 to excellent in a hurry. Remember, in 2022, they were cutting costs. In 2023, they built out an AI team led by Yann LeCun, who won the Turing test.
Oh, yes. I've interviewed him before years ago. Years.
Incredible individual. He won the Turing test prize. It's an incredible accomplishment, right? And now they've got a best-in-class model that they've open sourced to the world. Talk about a gift to humanity. We should come back to that. I think it's underappreciated what that means. So what they want to do is have the world's leading AI, and they're going to spend a boatload of money to attempt to win that. And I think that Meta is making a bid to disrupt. I'm not saying they will achieve this. It's very hard what they want to accomplish, but they're making a bid, and it's credible. We have to see how they execute, and they are executing. But they're making a bid to compete and take share from Microsoft, Amazon, Apple, and maybe Google. Let me walk you through that briefly. Okay.
Please.
So we'll start with Amazon. They're testing now the ability to do e-commerce transactions. This is what PDD is doing in China. That's why PDD stock is going up and Alibaba stock been in the dumps. Because in PDD is like a social media experience that allows you to buy goods. Meta's testing that now. That's a growth opportunity. If they dial that up, they can eat into Amazon e-commerce revenues. That's one. Okay. That's on Amazon. 2, they rolled out Horizon OS in the last 2 weeks. What's OS stand for? Operating system. Who builds operating systems? Microsoft and Apple. Have you ever heard of Meta consider an operating system? What's going on here? Well, here's what's going on. Microsoft got an incredible business in Windows and Office, cash cows, and they've been able to attach Xbox and LinkedIn, other businesses around that. The rest of the businesses are not that great, to be honest. They got dozens of other small businesses not doing that great. But do you really need an operating system when you have an AI that can spin up applications for you? You need an operating system, but not in the way you think of an operating system today. You don't need those applications like the calculator. You don't need Office. You don't need a spreadsheet. You don't need WordPerfect. The primary method we interact with AI today is chat. It's text-based. In the future, that could be video-based, like FaceTime, right? I could be an avatar. Maybe I'm an avatar right now. Right? And you can have interactions that are dashboards that the AI spins up that's tailor-made to your goals, your context, your preferences, which might be an application like a CRM, right? So I think Meta recognizes the opportunity to go after a prize that is substantial, and they're gunning for it. So that's Microsoft, in the cross. I think Microsoft actually has more to lose from AI than Microsoft is consensus AI in the public markets today, right? If you think AI, people say, "Oh, it's the
Of
Microsoft."
course, yes, ChatGPT, Microsoft, yes.
Which I think is wrong. I think it's a mistake. It's a misread. We'll see how they report after today. We'll see how they do with Copilot. I think they need more time to get that going and more traction. But I don't know they need all these applications. Applications that have community and interaction and built-in networks and proprietary data. Yeah, you still need that. AI can't replace data. It can't replace networks, although guess who's really good at networks? Meta. Certainly on the consumer side. Now, what about Apple? So Apple built this Vision Pro. We've been of the view that it's dead on arrival. We've been bearish on Apple since last summer. Stock hasn't done anything. Actually, it's done something. It's gone down. We think they're going to disappoint on earnings. I was disappointed that they're not building the Apple car anymore. The reason why is because the automotive sector does generate real revenue. Like if you want to grow Apple, an auto product is actually a really good idea. It's not clear how Apple is going to grow now from here. So it's going to go from a growth stock to value stock. But they built this Vision Pro, very heavy device. It's not used every day. What does Warren Buffett do? He invests in businesses that have daily usage, that have habit formation. Wrigley Gum, Coca-Cola, quick service, restaurants, banking products, and brands. So Meta's got Ray-Ban. That's a brand. Daily usage. That's the idea they're getting after. We'll see if it works. I'm going to order one soon. Let's see how it works out for me. But they at least have thought about it better than Apple. You're not going to walk around with the Vision Pro. It's just not practical. And so I think, look, they're spending a lot of money on this. There's no ROI coming from this billions in incremental Capex, which they were clear about. That's why markets punish them, right? But they're making a bid for a prize, a profit pool that is substantial. And they have demonstrated execution on the hardware front and the AI front. And Mark, I believe he's the only founder-led CEO of that peer group. So it's going to be really interesting to watch. I wouldn't bet against Zuck. Look, the bear case is this: when companies ramp up Capex, they generally underperform. Look, we saw this in 2021, where a lot of these big tech firms, they got ahead of themselves and they had to cut costs, and then the stock prices recovered, including Meta, right? Went up 400% from the October 22 lows after they made those cost cuts. So we got to make sure that they don't get ahead of themselves. I believe that Zuck has learned the lessons from that. He did sell a bunch of stock 2 months ago. He probably knew what he was going to share today. They have to announce these in advance, by the way, but those sales. But I like that he delivered the medicine in a very straightforward way to the markets, which is important. It wasn't like a slow dribble. It was like, hey, we're going to spend a lot on this. This is our vision. We have the technical chops. We've shown it. It's called Meta Llama 3. Check it out. It's already integrated in all their apps. So, I think Meta will be there in 10 years. I think Microsoft has more risk than people think. Amazon's got a great e-commerce business, but it's expensive. The AWS business is the best asset within Amazon. If I could own that, I would, but I can't. I got the same price I pay for AWS, I got to pay for Whole Foods. And there are these competitive emerging pressures from e-commerce on social media. So I think Meta's positioning is very good. I think Google's positioning is exceptional as well because Google has the data. Data is a moat. And the prize that Meta and Google are both going after is that personal assistant AI. I'm sure Microsoft will try to get after that too, right? So Google and Meta will have a heads up match. I'll own them both. That's fine. They'll differentiate. Google's got the Gmail client. They have the web. It's called search. Meta relies on Google actually for their AI experience. They're integrated there. Google's got a platform called Android. It powers the majority of mobile devices globally. Google invented AI as we know it today, what's called a transformer, and one of the most seminal papers of all time was written at Google. So, and they've got the free cash flow, tens of billions of free cash flows to finance, and they have more semiconductor compute than their peer group combined. They're using their in-house silicon based on plans built years ago. So Google has been thinking about AI for a long time. What they missed was the rapid adoption of GPT. They did not expect that to happen at the pace that it did. And so they're a little offsides from that. But they've got the capability in place. Apple doesn't. If you ask Apple Siri for the weather today, it might tell you it's going to rain. I say, well, what time? It doesn't know how to answer that question and answer some other question. It's terrible.
Well, I'm going to have a question for you on NVIDIA that is probably going to be a little bit of a shocker.
Okay.
It will be something I will be asking Adam Robinson later today live. Yeah. Right before I get to that, looking at some of my screens now. Robert R., thank you for your kind words. Something that came into me, I guess a backhanded compliment. Like, Angelo, you're like the Joe Rogan, long form, somewhat intellectual, but cool in the family office world. How come you don't have more followers? I asked the same thing. The platforms, I don't know, they don't seem to like me too much. I need an internal marketer to help on that. So if one of you are awesome at maybe breaking up and doing clips, whatever, I'm all ears, but thank you for the backhanded compliment. And let's see, Mark. So yes, how you could reach me among what I said. Also, just go to my website, angelorobles.com. Go to the membership tab. I'm going to talk about my 30 founding members that I'm building towards in the next couple of months. Maybe you could be one of them. That would be the key tab. And my email, thank you for some of the new people asking, Angelo at angelorobles, ROBLES.com. Simple. Okay, so I'm going to start off soft, then we're going to really take a hard curveball. The soft one, which is something you wrote and a company we didn't really talk about yet, part of the Magnificent Seven, you wrote, I believe, who's better to own, NVIDIA or OpenAI, which could be a little bit of a back way to Microsoft. And you really nailed it, that the NASDAQ has done better. Just the lowly NASDAQ, anyone could invest in it. What a shocker. Has done better than effectively the vast majority of quote unquote VC. Absolutely. How does that exactly rate to your comment? I guess one of them is public and one is kind of private with OpenAI, but NVIDIA, quote unquote, or OpenAI?
Yeah, excellent question. Number one, yes, QQQ has outperformed the vast majority of venture capital, certainly angel investing, even top quartile venture capital, which apparently every venture capital firm seems to advertise because they use marks as opposed to distributions of cash to investors, which is called DPI. people FOMO into venture capital and they lose money versus the opportunity of investing in QQQ, which does contain some of the best businesses in the world. Not all of them, but by and large, you do a lot better than that than in venture capital. And there are exceptions to that. I also invest in venture capital, but we're very selective, and we have an approach around that where we think we have some value added through all that, right? So, and the QSBS tax break in venture capital is very nice too. But so OpenAI, man, these guys are caught in the middle. It's just a bad spot to be. OpenAI was the FOMO deal of last year, raising an $86 billion valuation. They're charging $20 a month for AI that Meta is now charging $0 for. Google Gemini is charging $0 for. Both of those firms have ample distribution. They got reach. So they still have more to do to iterate and improve upon that, make the products better. It's search engine wars all over again, right? Google won the search engine war, the 18th player to the market. OpenAI depends on their parent Microsoft for the funding of these GPUs. Microsoft, they're going after enterprise. OpenAI is going after enterprise and consumer. So on consumer, they're flanked by Meta and Google. And Apple's trying to figure out what they're going to do there. They'll do something. So consumer is just hard. And then an enterprise, Microsoft is getting after that segment as well. So it's hard. It's a strange bedfellows, right? Microsoft acquired Inflection. They're internalizing more AI talent, I believe, to de-risk against issues around OpenAI, like Sam Altman was fired by the board and is brought back. Just and Satya Nadella is doing the right move. You have to de-risk that. AI is transformative. You can't screw that up. You better have the talent in-house. If you can de-risk for $1 billion, which you can generate pretty quickly, you should do that. So yeah, I don't think OpenAI is like a difficult spot. Look, if it went public, I'm sure the price would go up just because all the hype around Sam Altman, who is an incredible operator. It's nothing against Sam per se, right? It's just OpenAI spends more money. When I looked at this, like October, November of last year, on CoreWeave, which we're an investor in, than they generate in revenue. CoreWeave's a data center AI play. It's private. I expect they'll go public in Q4 of this year. And CoreWeave provides the AI cloud compute. They have data centers loaded with NVIDIA GPUs. NVIDIA is one of their investors. They're very efficient at creating GPU compute, and they provision that to Microsoft, OpenAI, and others. That's a picks and shovels infrastructure play, and it's a lot cheaper than OpenAI. We invested in that $7 billion in November of last year. There's a Bloomberg article that came out a few weeks ago saying that OpenAI is now seeing interest at a $16 billion valuation. That's like a 2x return, still paper returns, from November to early April. Not bad, but those are better plays than trying to pick a winner in a crowded category at the application layer, intense competition where these other players have different advantages. Rather, better to bet on the silicon layer, that picks and shovels infrastructure layer, find those oligopolies, find those monopolies that are the beneficiary of the capital expenditures at the application layer. So in the last month, we've seen articles. There's a great Bloomberg article talked about Amazon spending over $100 billion in Capex on AI. Microsoft's doing that. Meta's doing that. Google's doing that. That's great for the silicon layer. It's not actually great for shareholders in those companies. That's earnings that otherwise would have been that's getting transformed to expenditures to those Capex receivers. Now, whoever wins that prize, the application layer, is going to have a great prize, but you're not going to see ROI for a long time because they're in a brutal competition with one another to win the application layer, right? So it's going to play it over years.
Yeah, I mean, you really have this obviously incredibly well thought out We're going to continue with AI, my controversial questions on NVIDIA. And of course, we have to talk about Elon. So all of it's going to circle back to AI.
For
As a
sure.
reminder from one of my platforms, someone sent something in which also relates to Elon. One more comment on the private companies we spoke about earlier. Unlike VC, I'm usually, because I'm not into turnarounds, I'm buying profits. I'm buying existing profitable companies. Do you get it? Do you get how valuable
Yeah.
that is compared to pie in the sky, which is often VC? And by the way, oh, well, I'm not a real entrepreneur. Stop that. Did Elon invent Tesla? No, he purchased it and he made it incredible. Get off that thing that the only real entrepreneurs create companies. That's really hard to do, that really take off. You're better off buying them. You're buying a great idea. They're showing traction, and they might be, depending
Oh,
on your
Microsoft. Remember, Microsoft, the initial MS-DOS was an acquisition of some code, and
Yes.
Bill Gates commercialized it. It's better to be good at commercialization. Steve Jobs, saw Wozniak and said, "Gee, there's a commercial opportunity here. Let's figure out who the customer is. Let's bring this to the market." That's where the unlock is. The mistake entrepreneurs make is they lead with product as opposed to the go to market.
100%. Okay, I've been teasing the audience long enough. It's a three-part question. It's going to start off a little slow, and the third one's going to be probably why I never take off on social media, because I get in trouble. It is going to be related to NVIDIA. The soft one first. Is the heavy concentration of NVIDIA's revenue from a small number of large customers actually, Rob, is that a major risk factor?
I don't think it's a major risk factor because those customers have it as a top 3 priority to compete and win because the stakes are so high. If they do not compete and win, then their market caps are hurt by far more than they would be spending on these GPUs. Look at Apple's market cap. It's down a bunch, right? What, hundreds and hundreds of billions of dollars? That's far more than $100 billion in Capex spend over 8 to 10 years. The risk of not being AI relevant, ideally AI dominant, which is, look, most markets are winner take most, right? There's Coke, it's got the lion's share, then Pepsi, then everyone else. There's McDonald's, number 1, Burger King, number 2. Well, that used to be the case. Now it's like Chick-fil-A's on the rise and Shake Shack.
Oh, yeah, come on. Chick-fil-A is great.
But the basic idea that there's like leaders in the market. There's JP Morgan, number 1, number 2, Bank of America, and then a bunch of people looking for scraps. It just happens in markets. Okay. So, if they don't invest to compete for a number 1 position or a number 2 position, then their market caps will get whacked. Also, the best customers you can have in the world are governments and big tech companies. Why? Because they've got essentially unlimited budget. And also it's a high priority for them, so when I was in consulting many years ago, the question we'd always ask ourselves is this initiative a top 3 priority of the CEO? If not, forget about it. And AI is a top 3 priority for big tech. It matters to them. And governments, sovereigns. Dubai has 60 Saudi Arabia has 60 data centers. Wild. I don't think Saudi Arabia has that many cities, right? Saudi Arabia, that's just Saudi Arabia, right? What about China? So every country is going to need to be investing in data centers and AI.
Energy is what I see.
Energy as well, yes, for national security, also for surveillance, sadly, but that's going to happen. So, this is a major trend, and you can't get better customer quality than what you're seeing today.
Okay, Ron, that was the easy part 1 of 3-part at NVIDIA. It's going to get a little warmer. Here we go.
Sure.
NVIDIA is allegedly investing in AI startups. and then getting a significant portion of the investment money back as revenue from those startups purchasing NVIDIA's GPUs and other products. Are there any potential issues with this? You kind of hinted at it. Is it a little bit of someone has to win? You got to be a little bit of a bully. They're there to make money. But what's your opinion?
Yeah, NVIDIA did this with Inflection and with CoreWeave. I'm sure we could come with other examples.
Yeah, we're going to get to that. Trust me.
As long as it's disclosed and the accounting is clean, and I have no reason to believe that it's not, then I don't see what the issue is. In fact, it seems like a smart move. NVIDIA is investing in its ecosystem. NVIDIA's investment in CoreWeave made a ton of sense because you have Microsoft, Google, and Amazon looking to build their own in-house silicon, which is competitive with NVIDIA, right? So if you're NVIDIA, it's nice to invest in and help grow a player that isn't trying to disrupt you. And I know NVIDIA doesn't prioritize GPU delivery to CoreWeave, but maybe they should. They won't because it'll hurt their, Jensen won't be able to get a photo op with Mark Zuckerberg or, Modi. Have you seen him? The guy is so good at sales and marketing. I think he really is I mean this like in a very complimentary way. It's just very impressive.
Of course.
I'll share my screen real quick here. So I'm starting to collect these now. I just think it's quite interesting. But so you see that this is Jensen and Sam Altman.
Give me a second to pull it up. There it is, audience.
You see that? So NVIDIA CEO Jensen hand delivered the first DGX H200 AI system to OpenAI. Nice photo op. I made a joke that if Jensen touches you, you're going to get a GPU and you're going to lose $1 billion. So this is Mark Zuckerberg and Jensen. If you swap coats, you're going to lose $5 billion and get 5 more GPUs, right? So he did this. So he did this with Modi as well, right? We're talking sovereigns.
Yes. Okay. Now my third one. And by the way, I like to turn things upside down. I like to question. I don't want to anchor. I'm not saying that I agree with any of the questions looking for something negative. I think this is how we're going to hear it from you, from Adam Robinson later. This is how really smart people think. And this is having known family offices, incredible investors in VC. Sometimes there's some hedge funds. Like this is the work that I do in my private club, whereas families and peer-to-peer, we rip things apart and turn it upside down. Here's that final one on NVIDIA. There are claims that NVIDIA is recognizing revenue from contracts and services that have not fully yet been delivered. Could I argue artificially inflating their reported revenues and advancing credit lines to some of its major customers, like startup CoreWeave, which is using NVIDIA's H100 chips as collateral? Is it true that NVIDIA, could I argue, is that propping up demand?
Well, recognizing revenue before you ship GPUs, that's not proper. I don't know if that's the case or not. Like, okay, where's the evidence? I mean, NVIDIA is such a highly covered business. People will be all over this. I'm not saying that I haven't done any forensic accounting on NVIDIA. I just, it's like you got to focus your time and energy on what's worthwhile. And, they have audit. It's a highly covered security. Does financing purchases help grow demand? Yes, it does. Of course it does. Is it a good idea? Yes, it is a good idea. I'm an investor in a home builder called MI Homes that provides special financing to home buyers because mortgage rates are high. It's a way to grease the wheels. And because the margin on a home is so large, they can afford to give a better off-market rate. Merchants do this all the time with buy now, pay later. Right? So if you're a merchant, gross margin 50%, you can say to a firm, hey, look, I'll do some loss sharing. I can give up 10% of my margin to finance this customer's purchase of a high ticket item so that a sale gets done where otherwise wouldn't get done. Everyone's better off. the retailer sells a product that they wouldn't have sold. Yes, it's at lesser margin, but their net income's gone up. The consumer's better off. And the provider of the lending capital now has originated a loan. So, I don't know that financing, you might say, well, gee, like what's the net income from that finance? And that should not be valued at a high multiple. That I would agree with, but I don't think it's material.
And I don't necessarily disagree. I
Yeah.
just think it's, again, as an investor and knowing prominent people and knowing incredible world-class investors, sometimes we all think too linear. We don't think out of the box. We don't question things. And I think, again, part of making and preserving generational wealth is often on big plays, making the right decisions. So I think these are fair questions to bring up so we could think through it internally and effectively think for ourselves to make our own decisions.
If someone has any evidence of that, send it to me. I'll look at it. I'm happy to change my mind. I want to test my hypothesis, right? I just haven't seen anything credible. So the real thing you got to pay attention to NVIDIA is the investments in custom silicon, and does that displace the demand for NVIDIA? And if so, when and where? That's really what you want to focus on. Now, Taiwan Semiconductor reported earnings last week. And if you really want to get a handle on NVIDIA and all these other names, I think it's worthwhile building a spreadsheet. We've got every ticker in the semiconductor category, and you track the keynotes, especially focus on players like Taiwan Semiconductor and other infrastructure providers, like Applied Materials and KLAC, Broadcom, ABGO, et cetera, and look at their commentary because they'll build up towards NVIDIA, which is one of the last to report. So, and look at the 13F filings too, which will come out before NVIDIA reports to see if people have changed positioning, especially people who have material stakes in NVIDIA, right? Because they'll have expert networks that they're tapping into. So we look at all that. But what I saw in Taiwan Semiconductor is that auto EV semiconductor demand down. That was a predictor for Tesla's disappointing results. Computer, mobile, flat to down. They're expecting a recovery in those categories second half of this year. GPU up. So that's from Taiwan Semiconductor. Now what percentage of that is NVIDIA, what percentage is that manufacturing GPUs for the hyperscalers? It's not disclosed. But I think, NVIDIA still has the highest ROI compute. That's the key thing. Remember, the stakes are high. So you're not trying to go cheap on winning the war when the cost of losing is hundreds of billions of dollars of market cap or your relevancy to the consumer. You want speed, you want reliability. Imagine you build a data center with a bunch of AMD's chips and then your engineer can't roll out the feature the customer wanted because it's not in the CUDA layer or just something. It's not like they can't afford to make that mistake. They're not in the optimization game. It's not about a cost optimization game. This is a land grab, mind share, own the customer, win on AI to capture a big prize game. The stakes are high.
Now, in hearing that, and we're coming to probably the final 10 minutes, everyone, we will end with a comment question on VC and, of course, talk about Elon, including a little XAI. AI will never be weaker. We all know this, but it's a startling comment. Than this very second that we're talking now. It's not something that takes a year or two to get a little incrementally better. It is happening by the second. It's believed that AI will be 800x more powerful in 2 years than it is today in April of 2024. Like, there's no going back, which leads me to a quick question. And who would have thought this 5 years ago? Will NVIDIA have the largest market cap in the world in 2 years?
I think it's a fair shot on goal. They have a really good shot on goal, and for two reasons. One is they can grow earnings, but also Microsoft could see multiple compression for the reasons we described before, and so could Amazon. So they could pull ahead, and others could pull behind.
For sure. And before I get to my final two questions, one, I'll just read off. I love doing these, and Ram is very cordial as a guest. This is effectively our opinion. It's for entertainment purposes. I'm sure I'm talking for Ram as well. At the end of the day, do your own diligence, make your own decisions. Part of being a great investor in a great family office, and what you should be teaching your children, which schools don't do a good enough job in, think for yourself. Think for yourself. So at the end of the day, everyone's situation on liquidity, on their financial needs, on time horizons, all that is very different. This is meant to be fun, entertaining, engaging, but you have to make your own decision. Oh, and by the way, you may hear this in a day, a week, a month, or 10 years. And even a day from now, a little bit like playing poker, new information comes into me and Ram. And what smart people do, not that I'm one, but of course Ram is we form, let's go with the word opinion. And as new information comes in, we don't get anchored, we change it. So as information comes in, maybe everything that we're thinking that we're talking about today could be totally flipped. We're not anchored in an idea. In other words, I hope you're enjoying the entertainment. I like to ask thought-provoking questions that I may have no opinion of either way. And at the end of the day, make your own decisions and think for yourself. I would, and I hope many of you are enjoying the conversation. Many of you are not that familiar with me. If you were to go to angelorobles.com, I would go to membership. I'm looking for only 30 founding members in my private club. We meet effectively once a month, Palm Beach or New York, depending on the season. And people like Ram, who I'll soon be inviting to what I'm doing in New York. Imagine, I'm sharing this on Family Office TV. Every other, and it's not that I'm that talented, I'm not. I love what I do and I work hard at it. You're hearing a lot of boring, vanilla, plain talk, 20-minute, 30-minute conversations, no real insight. This is incredible insight you're getting, forget me, from Ram, from Leon Cooperman earlier in the week, from Adam Robinson, from Jolene Caruso, who I interviewed a day or two ago. And all my other interviews in crypto and AI, they're long form, they're deep. And imagine doing that live when you can really let the gloves off and have really honest discussions. So we'd love for some of you who are qualified to consider in terms of what I'm doing and be a part of it. Go to angelorobles.com to learn more. Okay, VC. And I am not the only one saying this. I'm just throwing it out there. Maybe I don't even agree with it. But Chamath, Polyatulia Chamath, basically said, man, VC is an insider's game. Are you part of Y Combinator? Are you Peter Thiel? Do you know who the real winners are going to be? And he also kind of basically hinted, arguably, our winners kind of made, meaning is it a little bit of an embedded Ponzi scheme? Let's focus on this company, put more and more and more money behind it. Others will now put more and more money behind it, and we hope it gets escape velocity and takes off. What I'm basically trying to say is even a billion-dollar family office that thinks they're cool, wants to be active as more of a direct investor, earlier stage in VC, really? Do you think you have a chance? Ram, what do you think?
First off, thank you for the kind words. I have to send this to my wife with a timestamp and say, look, I'm doing work on Twitter here. Believe me, I'm trying to add some value out there. But anyway, so I had dinner with a top decile VC last night, and he said, VCs traffic and inside information. If we did what we do with public securities, we, the VCs, would be in jail now. And
thank you, Ram.
That
finally we're speaking the truth.
Oh, it's totally true. I mean, it's
broadly VC to the audience.
They're not publicly traded securities and this and that, but VC is actually, I have a podcast called Lumina Non-Consensus Investing. And my last interview was with an exited Y Combinator founder. And, what he shared was the valuations Y Combinator gets, like the interview process. It's really quite interesting. But Y Combinator is getting, like 5 to 7 points of the company at a $1 to $2 million-ish valuation, which is extraordinary. You make your money on the buy, right? That's the key thing we keep coming back to. If your entry valuations are low and you have some screening process and framework, you're going to do all right. You're going to do more than all right. That's why Y Combinator has so many copycats now. A16Z has one, Sequoia has one, Peter Thiel's launching one, Bain Capital has one. They're all trying to replicate the Y Combinator. They're trying to move upstream to get a cheaper valuation and then cherry pick which deals work and put more money into that. Now, can you be a kingmaker? That's an interesting question, right? We saw some of this in the 2021 era where you had a SaaS company and it was manufactured to deliver conveyor belt into the public markets. It was like, hey, let me hire you a VP of sales. Let's ramp up growth and then take you public. And you saw valuations which had a price to sales of 100x. Remember Bird? I remember going to SF and seeing all these like scooters on the ground. That 100 to 1 valuation. Bananas. By the way, Cohere, an AI startup, has a 214 to 1 price to sales ratio right now, just to give you a sense of what we're seeing out there. A little too pricey for me, I would say. Not earnings. We're talking about price to sales. So I wouldn't go so far as to say that VCs can force outcomes. VCs will look to exit in public markets and de-risk. And we've seen a lot of duds that have been dumped on public market. Remember like Rent the Runway? The thing is awful. Look at Backed, BAKKT, those de-SPAC, awful, down 90%. Look at Beyond Meat. Awful, down 95%. So, even EV firms, like the Lucids and Rivians of the world. I mean, there's like SoFi down a lot, well below IPO price. I mean, I could go on and on and on. So there's a lot of junk that gets brought into the public markets. Not all of it's junk. There's some quality names here and there. You got to look for the sponsor. I saw a study that showed the correlation of forward returns to the sponsor. The sponsor is like the lead investors that's bringing this together in the public markets. Like Iconic is a good sponsor. They're actually the highest forward return. No, you can't. There are some limits during the FOMO period. A VC can get away with lifting a security in the public market if it's hot enough, and then hope they get to a lockout period and get out of thing. But some VCs are extraordinarily forward-looking and thoughtful and insightful. I put like Scott Belsky at that level. He a business acquired by Adobe, then was a Benchmark partner. I think he's no longer a Benchmark.
Yeah,
he's incredibly insightful, very thoughtful individual. There are others like that too. But most VCs are trend spotting, trend catching, looking at what each other is doing to make sure that if you're a seed investor, there's a Series A follow-on VC to be there, and the Series A makers, the Series B investors. So it's a lot more social than people think. In fact, like 10 or 15 years ago, I'd say like the acumen of the average VC was really quite high. Like the intellectual caliber and like the sharpness is really high. Now it's like, you have...
Well, you could be a Hollywood actor and be a VC. Let's be honest.
You have the sourcing, you have people on the ground. It's more social that gets.
You've got a social media following that is 5, 10, 15, 20 million. How much money could you make in crypto by effectively pumping and arguably pumping and dumping and so-called becoming a VC? It's kind of ridiculous.
Yeah, look, so some of these VCs are very good. I just want to be clear. Again, we invest in a handful of VC funds. Fortunately, they've worked out. But I have a VC fund I'm investing in where the entry valuation is $2 million per deal, plus or minus. That's what I want to see. And they require traction. They require revenue, which is incredibly de-risking because it means you have customers willing to pay and it's evidence of product market fit. So that's what I like in venture. What I don't like, we were offered the XAI deal, we were offered the OpenAI, the Anthropic deal, all these deals. We said no to all of that. We invested in Core, which I told you about. So far, that's working. Infrastructure layer, right? The XAI deal.
Well, I was going to segue to the final subject,
right,
and then I want people to learn how to reach out to you. So Elon, XAI, what do you think?
So, Elon spent a lot of money on Twitter $40 billion acquisition. He tried to get out of the deal. You know, he bought it somewhere in the early part of the bear market of 2022, realized he overpaid. Okay. So we know that's a fact. 2, revenues have dropped because of advertisers have pulled back. 3, they've invested in the product. By and large, I like the improvements in the product. And, he's adding monetization. It's very interesting what he's doing out there. I mean, I don't know no one's seen the profit and loss statements as business yet, right? So XAI, I think of as a way for Elon to raise money. I think if Twitter was bought at a $10 billion price, you would not see XAI. Like, why? The X in XAI refers to Twitter.
Mm-hmm.
So why isn't it in a new offering financing Twitter? Well, you can't, because the valuation would be lower than his acquisition price. You can't raise money at a lower price. You could, but it causes a lot of damage for every investor that put money in. Investors are betting on Elon because he's made them money, and he's got a track record of doing that.
Indeed.
Tesla and SpaceX. So I believe XAI is kind of like a backdoor way to raise money by having X license the content to a new entity called XAI, which will then use those proceeds to go invest in AI. So the expenses also move off of the Twitter or X P&L statement. So it's interesting. It's a clever way to do it. It does limit the upside, though, of X, right? Because, X will have some revenue share with XAI. They got to figure that out. But, X does not own the AI capability. It's another business, and the economics will be split in some way. So I think he did what he had to do. He needed more capital to buy all these GPUs from NVIDIA, right? In their earnings call, they talk about, they had $2.5 billion in negative free cash flow, by the way. They had an incremental over $1 billion in capital expenditures just to finance like these GPU AI infrastructure, $1 billion in one quarter. So I think he did what he had to do to get the financing he needed to advance, his vision of, an AI world.
Ram, I don't know what to say. It feels like our almost 2 hours. It goes by so quick.
They always go by quick. It's always a lot of fun.
We probably have to move these up to once a quarter. I really enjoy, and again, I've known Ram since my days of founding and running Family Office Association. Always knew even 10, 12, 13 years ago, he'd be the guy that was there asking the speakers the best questions. So hopefully I might have learned a little bit from him. And I really enjoy these conversations. I hope you do as well. Again, sharing long form, deeper intellectual content, sometimes with me a little crazy, but hopefully that makes it a little bit engaging and fun in investing, life, the family office world. We didn't really dive into geopolitics or macro today. Another time. I highly recommend, if you don't already, you have to follow Ram and reach out to him and his team. That's Ram as in RAM and Ahluwalia, spelt AHLUWALIA, co-founder of Lumida, LUMIDA. And Ram, I'll let you either one, have a parting comment, and two, share your must follow on X, what's your handle, and how people can reach out to you and the team.
Sure. First off, thank you again for having me. I'm very much looking forward to tuning into your interview with Adam Robinson later. So hope folks follow your podcast. Really exciting in your social media. So you can follow me on Twitter at Ram Ahluwalia or go to lumida.com, LUMIDA.com. We also have a podcast called Lumida Non-Consensus Investing. If you just type in Lumida, Spotify or YouTube, you'll see the content. We're also on TikTok too, but we're an SEC registered investment advisor. We provide private wealth services that includes trust, tax, and estate, primarily for founders, exited founders, GPs that want to create and grow wealth in a tax efficient manner. Our philosophy is non-consensus thinking. We do the deep work, find the secular trends, and invest in everything that we do. So yeah, thank you again, Angelo. It was always a lot of fun.
This has been great. I will give the audience a close from my perspective. I'll try to keep it by Angelo standards relatively short. First of all, again, a thank you to all of you. A thank you to Ram. I'm Angelo Robles, founder, I guess you could say, janitor, CEO. I love doing interviews at my family office TV. My podcast, in the true sense of the word, on Apple and Spotify needs to be updated. A lot of it hasn't been in a long, long time, but my material that is live on LinkedIn and both my YouTubes, one YouTube at Family Office. Yeah, that's a great handle. I got that back in 2008. That's my larger platform. And my other newer one, Family Office TV. What really helped me, which was, I think, 2 years ago now at Family Office TV, going from very little followers to over 10,000, was Michael Saylor. An hour and 45 minutes on Bitcoin, and challenging him and questioning him on certain things really kind of blew that up. So I guess I have to have Michael Saylor back, especially on Family Office TV, because although I'm pretty proud of the quality of guests and the depth of interviews, probably could use more followers. And again, I think in the family office world, boring, vanilla, you're not really getting a lot of deep intellectual content. You're not being told the truth. And I have a saying, mediocre, which is most family offices, want to be left alone. Good ones want to be mentored. The few that are great, about 3%, and I admit some of that's qualitative, want to be told the truth. And that's why I like to be blunt. I like to be direct. I don't have to worry about politics or something like that. I could say what's on my mind, even if it is a little quote unquote off the beaten path. So those are updated at Family Office and Family Office TV on YouTube. I'm moderately active on X, a little bit on some of the other platforms, but LinkedIn. Just look up my name, you'll find me, and reach out to me at angelorobles.com. Simply my name is my URL. Not the greatest website in the world, working on it, but really take a look at what I'm doing in membership. I'm looking for 30 founding members. We're getting there, about halfway there. I really just started. And we're going to be co-based in New York and then Palm Beach in the winter. But I do love Jackson Hole. I love LA, Miami. We'll have mixed around, maybe a little bit of the Hamptons. And although I love intellectual work on digital, my master classes and best practices, the audience has spoke. You do want intimate soirees, roundtables, lunches, and dinners. Face-to-face still matters. I don't care about sponsors. I care about people that are active decision makers as principals, as rising generation, and selectively family office executives. If you want this kind of conversation with the gloves really off, and it's just private among us and sharing ideas and investing, especially on direct investing, a topic that we spoke about earlier, and insights and connections and access, then you want to be a founding member. That's not only favorable pricing, it's special benefits that I'm giving to founders. It's all up. It's easy to find at angelorobles.com. So thank all of you. I appreciate all of you, or some of you that are following on social media. I could use more. Go for it if you enjoy this interview. And those that are live today, if you subscribe to LinkedIn and others, you can hear my live at 4 o'clock Eastern with the before mentioned and pretty incredible. And that'll be another 2 to 2.5 hours with, again, the one and only Adam Robinson. So I hope you're enjoying it. I'm nothing. It really comes down to the quality of my guests. I'm fortunate to know incredible people like Ram and Leon Cooperman, who I mentioned, and others, and to share questions that I'm intrigued and fascinated by and don't want to cram it in to a boring 10 or 20 minutes. I want detail so I can help to formulate my own thoughts and make decisions and move forward. Anyway, enough. I hope you enjoyed it. Ram, you've been incredible as always. Thank you for you and your wonderful team. I appreciate all of you. Look forward to the next time. Thank you.
Thank you so much, Angelo. Be well. Take care now.
Be well.